Hey everybody, it's Matt Wright, Alliance West Mortgage, here with your lender tip of the week. So last week on Wednesday, the Federal Reserve hiked rates for the first time in 3 years. And so, I mean, a lot of calls from, especially pre-approved buyers wondering if their mortgage rate is automatically now 25 basis points or a quarter percent higher. And that's just not the case. Mortgage rates are not directly impacted by a Federal Reserve rate change. The Federal Reserve controls a rate called the Fed funds rate, and this is the rate at which banks can borrow from each other, mainly to fulfill capital requirements overnight. So they will borrow from each other to make sure that they have the right capital requirements in place, and they will pay interest on those loans. Now, when the banks pay more, we know what they're going to do is just turn around and charge the consumers more for the various types of loans that they offer. So that would be things like credit cards, auto loans, student loans, personal loans, and corporate loans, as far as most of the loans that they would see these rate increases on. So it does, in fact, make the cost of money more expensive for the consumer. And what the Federal Reserve's target here is to get the inflation rate in control, because inflation is incredibly high right now. It's the highest it's been in 40 years. Mind you, last time inflation was this high, interest rates on mortgages were 20%. So a lot of the reason that we see rates still as low as they are is because of the Federal Reserve's involvement in controlling interest rates by buying mortgage bonds and treasuries in the secondary market. But that's a whole other conversation. As far as what's happening right now, they're increasing the Fed funds rate in order to make the cost of money more expensive, and this in turn will cause people to borrow less, spend less. Corporations will be borrowing less because they're paying more interest, et cetera. So what happens when the Fed hikes rates is that things start to slow down because things get more expensive, less spending, slower growth. And usually what happens when there's slower growth rate is the stock market tends to decline. So just because they're not making as much, there's not as much buying, there's not as sales, et cetera. So when the stock market declines, what generally happens is the money that's leaving the stock market goes into the safety of fixed income. And that's where mortgages trade. So people want safe bets. They buy mortgages, they buy government debt, treasuries. And so usually what happens when we see these rate hikes is that eventually this just trickles down into mortgages and actually causes rate on mortgages to go down. So in a lot of cases, especially this year, we're expecting to see 6 to 7 more rate hikes this year alone. And that means there's only 6 meetings left for the Federal Reserve. So that means that they're targeting at least one of them to do a 50 basis point hike, which is a good amount. So I guess what I'm getting at is that mortgage rates are likely going to go down because of this, assuming there's no other catalyst that shakes things up. Like if the Federal Reserve were to stop buying mortgages and government debt, which they are right now, which is keeping rates low, that would potentially have a negative effect on mortgages. But all in all, Federal Reserve rate hikes in the long term are likely going to be good for mortgages because it's going to slow things down. Likely in the next year, we'll probably see a recession. I'm thinking in the early 2023, sometime within the next 12 months, because the cost of money is going to get more expensive. It's going to slow things down. 2 quarters of negative growth, and we're in a recession. We'll probably bounce back pretty quick, but that's likely to happen. And during recessions, interest rates on mortgages usually get really low. So I would expect rates on mortgages to stay around where they're at now, because the market's kind of already digested what's going to happen. Maybe go up, go down. We're going to be in a volatile situation, especially what's happening in Europe right now. But in the long term, we're probably going to see rates come down. So anyone buying a house right now is likely to be refinancing within the next 12 months when rates come back down. So a good opportunity to buy, because prices are certainly not going to come down. And if you look at the past, 8 or 9 recessions, home prices have done incredibly well, scream out of a recession because interest rates come down. So I do hear a lot of, okay, if Fed's hiking rates, the market's going to crash. There's really nothing that says that's going to happen, especially if we've already really seen the market digest an increase in mortgage rates, and we're going to see a bunch of rate hikes this year that are likely going to result in mortgage rates coming down. It's potentially we're just going to see a steady incline in home appreciation, rates come down, and then it's off to the races again. So, again, there's always variables to this. There's external things happening right now that could influence mortgage rates and the stock market, and all these different things. But I'll tell you right now that on Wednesday, there was a knee-jerk reaction to the Fed rate hike. Rates on mortgages went up, mainly because there was an indication that they may be looking to stop buying mortgages at some point in the near future, or within the next year or so. But the last 2 days of the week, last week, mortgage rates went down. So Fed rate hike went, on Wednesday, rates down by Friday. So I would expect more of that to come over the next Fed rate hikes. So I hope that helps explain kind of, what's happening right now, and what to expect going forward. But again, I think we're going to see lower rates here the next year. Anyone buying a home right now, possibly high probability that they're going to be refinancing into a lower payment. So still a really good opportunity. Any questions or concerns, always feel free to reach out. Thanks so much for your time. Take care. Bye.